if you're doing the options wheel strategy but you only have a smaller account, then this video will be perfect for you. Inside, what I'm going to do is I'm going to walk through the fundamentals of a company that's a really, really good stock, both for potential long-term ownership and the premiums are good enough to make it a solid candidate for the wheel as well. So inside, I'm going to show you why I believe this is such a good stock, the kinds of strike prices you should be looking for when you're selling options, and also the long-term potential of the company. If you don't know who I am, my name is Oliver El-Gorr. I run a company called Freeman Publications, and for the past 5 years, we've helped thousands of people start and scale their wheel strategy trading accounts. So let's get to it. Because before I get into it, I want to talk about the journey the stock has had, because it's been a ride. The ticker, Derek, is LMND, Lemonade. So what a ride it's been. They went public in the middle of 2020 because it had technology in the name. Straight away, it went absolutely insane. Then pulled right back. Unlike a lot of these growth stocks, it didn't keep running throughout 2021. It really just peaked at the beginning of the year and then kept plummeting. And plummeting and plummeting and plummeting and plummeting all the way till it gets to almost less than $10 a share. Slowly, things are slowly. It's only in the past couple of months where things have gotten really good. So currently trading at $43 a share, which puts it at a market cap of around $3 billion. So it's a smaller company, but it's not tiny by any means. Revenue over the last 12 months has been almost $500 million. And they are still not profitable. But I'm going to talk about that in a little bit. So, first of all, what does this company do? Just going to go on their website to kind of highlight it. They are a technology-first insurance company. The whole idea of the company is that they don't rely on the traditional insurance distribution model, which is you sell insurance through insurance agents. So if you're getting life insurance, for example, you call up an agent, or an agent calls you, and you go back and forth, yada yada yada. They don't really do that. Instead, everything's done online. They started out with two smaller verticals. So their first one was renters insurance. Their second one was pet insurance. Since then, they've expanded into larger verticals, notably automobiles, homes, and term life. So they currently serve 5 verticals. And as you can see here, pretty transparent pricing. They tell you the lowest you're going to pay. And this is kind of their selling point. You can get claims paid out in as little as 3 minutes using whatever you want to call it. Technology, AI, machine learning. We'll talk about the AI angle in a little bit, because this is not one of those like AI hype companies. This is the same company it's always been. The message has always been the same. There may be a few more mentions of AI now, but fundamentally it's the same company as it was 4 years ago. So if you're thinking, well, if it's the same company it was 4 years ago, why are we talking about it now? And it all has to do with how well they have executed. Because the insurance industry fundamentally is very simple. Insurance is a game of math. Now, what do I mean by that? If you're an insurance company, your entire business model is just understanding risk. On an individual level, how much risk does this person bring to our business? For example, Bruce says at one time you could insure your pet You can still do pet insurance on Lemonade. I tried, but my pet was denied. Now, I don't know why that was, but in simple terms, your pet was deemed too risky for the amount of money you would pay. On an aggregate level, insurance is okay. On an average year, how much are we going to have to pay out versus how much are we receiving in premiums? And insurance is a great industry to demonstrate the difference between volatility and risk. Insurance is traditionally a very low risk industry. However, it is a very volatile one. Because let's say you're in the homeowners insurance space and someone insures their home with you. They may not make any claims for 20 years. But in year 21, let's say if you live in Florida and hurricane, was it Milton or Helene? Suddenly you've got a $400,000 claim on your hands. That's the difference between risk and volatility. Volatility because the premiums went up and up and up, and then that one year they lose tons of money. But the risk is they have factored that in to all of their calculations. Give me a 1 in the chat if you're following along so far. Cool. Robert, good to see you. I got a very nice gift from Robert today, so thank you very much, sir. In the insurance industry itself, there is a term for this, which is loss ratio. Loss ratio is very simple. How much premium have you earned versus how much did you pay out in claims? Now, the problem that Lemonade had when they went public and throughout most of the last 4 years is that this, what is called gross loss ratio, was far too high. Because they prided themselves on being a lot lower priced than competitors. Now, the knock on this was, yeah, they're lower priced because they can't make any money. Anyone can charge low prices if they don't make profits. It's a lousy business model, but it is possible. And so this number, this gross loss ratio, is what we were also focused on. So Q3 of 2022 was 92%. So that's just out of every $100 in premiums they received, they paid out $92 in claims. Now that's before they've paid any staff, done any R&D, spent any money on technology, spent any money on marketing, and they made large losses. And the market decided they didn't want to pay a lot of money for a company that lost lots and lots of money all the time. However, over the past 2 years, this number has steadily decreased. See, the trend is down, 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 down. It's gone down for 6 consecutive quarters now. And it's currently 77%. So now, out of every $100 they receive in premiums, they only pay out $77 in claims. Obviously, that's a lot better. Long term, we would want this to be below 70%. So there's still room for improvement here, but we are very much trending in the right direction. And if you get nothing else from this, if you get nothing else from the next 45 minutes, it's this company is fundamentally in a much better position today than it was 1 year ago, 2 years ago, 3 years ago, 4 years ago. So if you wanted to be really short-sighted and you just look at stock price, you could say, oh, it's gone up so much in the past year, why would you be buying now? And I talk about this a lot. The reason that I'm okay with buying now is that this is the best position the company has been in since it went public. And hey, if we zoom out even more, we're still 75% down from the all-time high. So this is why sometimes it's good to wait. Give me a 3 in the chat if you're following so far, if this is making sense to you. Just on a very surface level right now. Fantastic. So Jonathan says, one thing I wanted to know, considering when I was comparing this to other insurance companies, they don't use the float to invest. Instead, they use it to pay out claims and do donations to charity. So they use reinsurance to lower volatility. But I want to know, are they a steady profit play? Because they are definitely not huge growth, right? They are not what I consider hyper growth by any means. But the fact is, they're growing top line by about 20% a year. They're now making $500 million a year in revenue. So this is not a small company anymore. If they can grow the top line at 20% a year over the next 5 years and steadily improve this number here, gross loss ratio over time, then they will be a proven, profitable, cash generating enterprise. Now, the other part of your question that I thought was interesting was this charity thing. Now, this has been a big part of their marketing. They call it the give back model. We take a flat fee, pay claims fast, and give back what's left to causes you care about. So, in other words, this float, and I'm not going to play the sound here because it's annoying. This float, which some companies would reinvest, some companies would invest to outside means. Lemonade does this thing called give back, where any excess unclaimed money is given to charities. As Jonathan says, it's a big time play on millennial and Gen Z social values. There's also an interesting thing here with regard to lowering fraudulent claims. So the insurance industry, especially the health insurance industry, has been in the news a lot over the last couple of weeks because of the horrific events that happened to Brian Thompson. Now, I'm not going to touch on this from a political level, but the overarching view of people who will make fraudulent insurance claims is, oh, it doesn't matter if I make a fraudulent claim because it's a massive company, no one gets hurt. Lemonade's view is, well, if we lead with this give back angle, we're less likely to experience fraud because people will be aware that they're taking money away from charities and people in need, as opposed to this giant, large insurance conglomerate. Now, I actually looked into this and I thought, is there any actual data that this does lower the amount of fraud that goes on in the platform? And I couldn't find anything. I couldn't find data either way. So for me, this is like a nice to have, and it makes sense given their target customer base. But in terms of, is it actually a fundamental core part of the business being better? I can't say either way. Jonathan, does that answer your question? Cool. Now, here's what I think is really, really powerful about this business. Insurance is an extremely price-sensitive industry. Give me a 4 in the chat if you've been mildly perturbed, PO'd, annoyed, frustrated by your insurance premiums going up in the past couple of years. Nina, good to see you. Me too. Me too. I'm sitting here thinking, I thought my car insurance was supposed to go down if I don't claim on it. but it seems to keep going up. So insurance, very price sensitive industry. So being able to charge low prices is a big win for an insurance company if they can do it profitably. And here's where I think Lemonade has a real advantage. So this is an example they use. This is from their Investor Day presentation. So they're using the example of auto insurance. So if you go to a large insurer, let's say Progressive or what's the one? Allstate. Is that the one? Is that the red one? Which is the red and white one? I'm in the UK. Apologies. Allstate. Okay. State Farm. That's the one. State Farm with Jake. I like Jake from State Farm. So if you go to a State Farm or if you go to a Progressive, they group you. Age, gender, credit score, marital status, where you live. It's a generalized grouping. A few years ago, Lemonade bought a company called Metro Mile, which actually can individualize your car insurance based on how you drive, where you drive, how much you drive. So a true reflection of your risk to an insurer. So here they do the example. So the average includes bad drivers, but also good drivers, because you're in similar demographics, psychographics. However, for a lot of people, if you're the jack in this scenario, and just because you're younger doesn't mean you should be grouped in with all other young drivers. So if you're Jack and you can prove that you're a better driver, you can actually save money on your insurance. So you see here, Jack can save $400 compared to another insurer. If you're Jill, for example, if you're the one moving the average up, you should just go to the other insurer. But the Jacks of the world can legitimately save money. And so that's the kind of people Lemonade are targeting. You see here, the third of people above the line are worse than average risk and they're better off going elsewhere. However, the 2/3 below the line are benefiting from Lemonade. Now, this is all nice, right? First of all, before I move on, give me a 5 in the chat if you understand the logic and the math behind how this works. Fantastic. So Lemonade has been able to charge lower prices. Now, once again, as an investor, this is all nice. How is it actually translated to the bottom line? So you've got premium per customer, which is growing even though total customers is growing at a faster rate. Usually what we would see is if total customers is growing quickly, we'd see premium per customer shrink because we got more newer customers coming in than we have long-term incumbents, and the newer customers tend to pay less just because they have less products. Lemonade is growing both. How have they been able to do that? Once again, if you've got insurance running in 5 verticals, what are people going to do? Let's say you're a renter. You got a car? Oh, you can get savings when you bundle. I'll put my car insurance through them. Got a dog? I'll do my pet insurance through them as well. Renter graduates to a homeowner? Do the homeowner's insurance through them. So they're upselling and they're cross-selling existing clients. And that's how they've been able to increase both these numbers simultaneously. Number of total customers, but also premium per customer. So the premium per customer is now $384 a year, which is really impressive considering only a couple of years ago, it was less than $300. So they're keeping this increasing. And that's what has really turned around this company's fortune. They're not GAAP profitable yet, but they are free cash flow profitable. And they do now have 300 million in net cash. So what that means is we no longer have the risk that this company is going to go out of business. As it exists today, this company does not have the risk of going out of business, which was a legitimate concern 4 years ago. The other part of this is they're free cash flow positive. They generate cash flow. They can sustain their own growth, which means they don't have to do what? Let me know in the chat. What don't they have to do that I hate as a shareholder? Umesh, good to see you, my friend. Fun, good to see you as well. Yes, Robert and Aman have nailed it. They do not have to issue more shares, which is going to dilute me as a shareholder. So let's look here. So they go public in 2020. So obviously, when you go public, you issue a ton of new shares. That's not unexpected. More dilution happens, but then we still have dilution way above what I want to see. This is 2 years after they've gone public, 6% of the float has increased. 3 years after they've gone public, 7% of the float's increased. So now, earnings have to be 7% higher just for me to break even. In the latest 12 months, shares have only increased by 1.5%. Now that is a rate I can live with. Because especially, it's still a growing company. I don't expect them to not issue any new shares. They have to hire talent. I get that. But 1.5% is a much more acceptable rate than 6 and 7% is. So for me, that's fantastic. That's great to see. The other part of this is we have a CEO. Why is this not checked? That should be checked. We have a CEO who owns 16% of the shares. Daniel Schreiber is the co-founder and the current CEO. Now, Mr. Schreiber has had a pretty interesting ride as a public company CEO. A big reason that this stock got absolutely slammed at the end of 2020 and the beginning of 2021 because Mr. Schreiber sold a big chunk of shares. Well, it was actually 3 lots of big chunks. The last lot being around $48 million worth. And he sold at what proved to be almost the top. Now, I'm not saying he did this nefariously. I'm saying that it probably wasn't a very good look. But then again, I have the benefit of hindsight. And he hasn't sold any shares in the past almost 4 years now. So it's coming up on 4 years since he last sold any shares. So he's ridden it all the way down. And now he's riding it back up as well. And he owns 16% of the float, which is what you want. We like owner-operators. And this also has meant that, this stock was very heavily shorted. It was one of the most shorted stocks. So short interest is declining now. So 32% of all shares were shorted at one point. It's now down to 21%, which is still on the high side, but it's trending in the right direction. A man says, has there been any buying from insiders? Well, let's take a look. I don't think so, but I can take a look. So let's see. SEC Form 4 Lemonade. So we've had sales, we've had some purchases. Let's look. I just want the last 1 year. That's what I want. And this is all public information, by the way. So I'm not doing anything sneaky here. So we've had what looks to be regular sales from the chief business officer. We've had some purchases from the CFO. Nothing from Mr. Schreiber himself. Big purchase here, though. And then we have, obviously, the stock option awards as well. And I should be very clear here. Insiders selling is not a major concern. Insiders sell for all kinds of reasons. So, for example, here, the chief business officer sold $4,000 worth at what looks to be one of the lowest points of the last 52 weeks, $16 a share. The stock today is 43. It's when we see a lot of insider buying, that's when we get really happy. But insider selling happens a lot more frequently, and it's no major cause for concern. So what we have here is a business that has turned the corner. We have a business that has shown that there's no longer an immediate blow up or dilution risk. We have an owner operated business that you can argue has a technology advantage as well. So let's play devil's advocate for a minute. How is this investment not going to work? Talk me through what you think could be the issues here, and then I'll go through what I think could be the issues. Because if this is your first one of these calls for us, we always have to understand the bear case as well. We're not just blind optimists here. We've got to be rational in our analysis. Ian, good to see you, my friend. You missed my Iron Brew demonstration. What could be the issues here? CEO retires, yeah, it's possible. He's pretty young though. I think he's in his late 40s, early 50s. Are they going to tell me how old he is? Claim season increased environmental damages. Possible. Raphael says premiums get too low to cover claims in the future. So we have a insurance risk itself. Few people have mentioned the environmental issues, which has affected, I think, a lot of insurance companies. And I think those are all pretty good reasons. For me, there's a couple of things that could go wrong here. The first is competition. And whenever we're thinking about a smaller company in a space with a lot of larger companies, Lemonade's a $3 billion company. Progressive is what, like an $80 billion company? You're competing with Geico, competing with a lot of big heavy hitters. State Farm. Is Nationwide an insurer? I always get confused because in the UK, Nationwide is a bank. But I think in the US, Nationwide is an insurer, right? You have large companies that could dedicate a lot more resources to the technology angle. The issue is, and Lemonade talk about this, the insurance industry has been built on a different business model and a different distribution mechanism. You know, I've had to do some insurance claims myself in the past few months. I say some, I mean one. And it's been a horrible experience. It's my first time really going through this, and it's been an absolute nightmare. Going back and forth, the company trying to wiggle out of stuff, getting to the point where I have to literally, and this is one thing we can do in Europe, I can request all of the conversations that I had with the insurance agent at the time of sale to prove that I am correct. So they have to legally send me recordings of the conversations. But what I want is really just for them to be lemonade and pay out claims in 3 minutes. That's what I want. I don't want to spend hours going back and forth. I don't want to call 15 different helplines. I want to be able to make a claim on an app. That's all I want. No, Ian, it was not a boiler. It was good old health insurance. So just because a company is larger doesn't mean that they can do a 180 and just steamroller the smaller competition. Otherwise, innovation wouldn't exist. On the flip side, some larger companies may move into the technology first approach. As Jonathan says, like Geico. You know, Geico has always been a big innovator in the insurance space. They're looking to move into what is called insurtech. And Geico is probably, Geico's no longer public anymore because Berkshire completely bought them out. But if I was to guess how big Geico would be if it were a public company, I would estimate it would be between 20 and 30 times the size of Lemonade. So if you have a company that can dedicate so many more resources to that, then there is a real risk that your advantage becomes eroded very quickly. The other thing that we want to see going forward is, can they maintain this pattern? Can we get to 70%? Or is this as good as it's going to get? Because let's say the next quarterly results come out and this is suddenly 83%. Not looking so hot right now. What I will say on the bullish side is, at their Investor Day 2022 presentation, so 2 years ago, William, 75% and below is considered good. Since their Investor Day 2022 presentation, they outlined a bunch of targets. So some of those were, cash flow targets, some of those were loss ratio targets. And there were 17 in total. And they have exceeded 17 out of those 17. So every single target they set for themselves, they have exceeded. So right now, this says to me this is a company operating at a very high level. You couldn't say that a couple of years ago. You couldn't even say that a year ago. And this is why I think it's so important to just take price as one element of an investment. Because if we only invest on price, then you're thinking, okay, it's 43. We need to get it. We need to wait until it goes back down to 10 because the company can get that cheap. But if you think like that, then you never invest in anything good because the company here was a different company than it is today. Just like the company here was a different company than it was today. And I say this in week 1 of the program. I'm okay with paying a higher price if it means I get to buy a better company. I'm okay paying $43 a share for this. Knowing what I know now, I would not have been okay paying $10 a share a year ago with that data in mind. You can only go off what the company is actually doing as a business, not just look at share price in a vacuum and go, it's expensive, it's cheap. A man, they said long term they want it to be below 70%. A man's asking, what's the target loss ratio? But that little tip, but give me a 7 in the chat if that makes sense about the stock prices and how the company has changed over time. It's good to know. In terms of what price I'm happy to pay, in the valuation model, I've got a fair price at $48.65. It's currently trading at $43.50, so it's a little bit below what I think is the fair price. If you want the numbers, let's look at the numbers. So this is with a 2% annual share growth rate, so slightly higher than it was in the past 12 months. You know, I could just take it at face value and say 1.5% indefinitely. I do want to be a bit more conservative though. I'll say 2% share increase year over year. These are the revenue forecast figures. And then once again, I'm using the lower valuation of a forward sales ratio of 4.8. You could argue this is a little bit high, but once again, I can only go off the multiple that the market is currently attributing to the company. I'm not going to go off a historic forward sales of 10. That would be insane. So with that in mind, the fair value today is $60 a share. Taking away 20% for a margin of safety, that brings us a fair value of $48.65. So the stock's trading about 10% below that right now. So I think the current price is completely fair. And that's lemonade. A man says good to sell puts then. Let me take a look, see. Let's look at selling some puts on lemonade. See what we can get for the options, guys. So I can get, I mean, I'd be very aggressive. I'd be selling probably 41 or 42 puts. That would get me down to a cost basis of less than $39 a share, which I would be perfectly fine building a position from that level. And this is purely selling puts for the purpose of long-term ownership, by the way. So, man, I hope that helps. Any other questions on lemonade? Then I'll get to, because I've got some other stuff to talk about at the end as we wrap up for the year. My goodness. Bruce, I'll get to your questions as well. If not, give me an 8 in the chat if you enjoyed this. That's what I want to hear. If you got to the end of this video, then I'm going to make the ever so bold assumption that you somewhat enjoyed it. So if you want more videos like this, there is a playlist in the bottom left-hand corner. Yeah, that sounds about right. Your left, my right. And from there you can watch more videos about me doing the wheel strategy, stocks that work best for this strategy, and really just more of the same of what you've just watched. And then if you do want our help setting that up with you, putting it into your account and teaching you really how to do this the exact same way I do, there's a link down below in the description and you can speak to myself or one of the team about whether it's going to be a good fit or not. So, hope you enjoyed this video and I'll see you in the next one.